After studying this module, you shall be able to understand the concept of capital budgeting at international level, know about the technique of capital budgeting, that is the net present value, understand the issues involved in international capital budgeting, know the concept of adjusted NPV. To begin with, capital budgeting is a method by which organizations decide how to allocate funds for investment opportunity. The financial managers have to determine whether spending money today is going to make their company reasonably more profitable in the future to back up the expenditure today. However, in appraising projects that goes across national boundaries, business must deal with number of problems. Multinational concern assessing foreign investment decision find their analysis problematical by a variety of problems that domestic firms counter occasionally. There are numerous factors which is unique to the multinational capital budgeting. This module examines several problems including how multinational capital budgeting can be done and concentrated on three dimensions of foreign investment analysis that are not taken into account in analyzing domestic projects, like difference between project and parent cash flow, problems in foreign investment analysis, and adjustment of risk. This session also helped to develop a methodology to make decision and determine the valuation of international projects. When considering the value of a project done by a foreign subsidiary, we use multi-step approach that begins with the discounted cash flow of the subsidiary and then makes the adjustment necessary to determine whether the project is worthwhile from the parent's business point of view. This approach is called adjusted net present value or ANPV. Therefore, present module discuss about the evaluation, international project and foreign investment proposals. In multinational capital budgeting decision making process, the manager has to appraise the factor by using standard discounted cash flow technique in addition to other factors solely belong to the international capital budgeting and apply alternative methods of treating them. MNCs evaluate a direct foreign investment proposal using capital budgeting process, but this capital budgeting is different stand from domestic capital budgeting. Once a firm has compiled a list of prospective investments, the next objective is to select that combination of projects that maximizes the company's value to its shareholders. Multinationals usually find their analysis complicated by a variety of problems that are rarely, if ever, encountered by domestic firms. Several such problems include differences between project and parent company cash flow, foreign tax regulations, expropriation, blocked funds, exchange rate changes and inflation, project-specific financing, differences between the basic business risks of foreign and domestic projects. Issues in international capital budgeting. Parent versus project cash flow, exchange rate risk, transfer prices, political or country risk, and tax factor. Substantial differences can exist between project cash flow and cash flow back to the parent firm because of tax regulation and exchange controls. Also, in many project fees and royalties are given back to parent company. Furthermore, the incremental revenue contributed to the parent MNC by a project can differ from total project revenue. Given the differences that are likely to exist between parent and project cash flows, question arises as to relevant cash flow in project evaluation. According to economic theory, the value of the project is determined by the net present value of future cash flow back to the investor. Thus, parent MNC
should value only those cash flow that are repatriated net of any transfer costs, because only accessible funds can be used for the payment of dividend and interest and for reinvestment. It is one of the additional aspects that have to be taken into account. Exchange rate risk refers to the risk that rises due to fluctuations in the exchange rate between foreign and domestic currency. To minimize this risk, at least partly, business may use various techniques. Particular cash flows can be used as an effective tool in the short term. Further, a concern can borrow in the foreign market, in the foreign currency, to minimize long term exchange rate risk. Transfer prices is another important aspect that has to be considered and refer to internal prices, which are different from market prices, on goods or intermediary goods, which are going from one subsidiary to another within multinational corporation, that is M&E. It arises due to the approach of multinational corporations to price products exchanged between subsidiaries at prices which are not allied with the market prices, to reduce the tax that the companies or the MNEs has to pay. Transfer prices have disturbing and misleading effects on the capital budgeting decision. In other words, because of transfer prices, the value of the cash flows and that of the project is likely to be misleading. This occurs because amount of cost and addition cash flows are distorted, and therefore data which is incorrect is used in the capital budgeting decision. To minimize distorting effects of transfer prices on capital budgeting analysis, MNEs need to make few accounting adjustments. Firstly, MNEs need to use market prices in capital budgeting analysis. Secondly, any fees and royalties paid from one subsidiary to another or to parent, as well as appropriate fixed cost, must be added back to the cash inflows. Political or country risk is another consideration that must be taken into account and refers to risks associated with doing business in particular country. Political risks may include difficulties with transferring returns on investment, that is, repatriating profits from the foreign country to domestic due to foreign government's actions or even expropriation. Political risk can be partly counteracted by sharing risks via partnerships with local businesses that will have a better understanding of how to most efficiently and safely conduct business in that specific country. Discount rates or the cost of capital should reflect the level of political risk. Other country risks include domestic and uprisings, such as the May 2010 demonstrations in Bangkok, Thailand, which effectively shut down the commercial hub of the country. Such an upheaval would impact both domestic delays in building hotels, etc., and international decisions, that is, changes in foreign exchange, country risk profiles, international insurance rates, etc. Overall, the international capital budgeting decisions incorporate all the issues that must be considered when operating domestically. However, there are few additional considerations that must be taken into account. The adjusted present value technique is often used to incorporate such additional risks into calculations. Because only after tax cash flow is relevant, it is necessary to determine when and what taxes must be paid on foreign source profits. On one side, tax treatment of foreign source earnings is quite complex. There are several stages in the taxation of all income from foreign investments. First, the local government involved in tax profits. If the tax concessions are granted, however, the tax rate can be zero. Generally, the company pays a withholding tax to the local government on that portion of profit which is remitted in the form of dividend, interest fees, and royalties. However, tax can be avoided if it is taken in the form of loan repayment. The process of evaluating specific long-term investment decisions is known as capital budgeting. The investment decisions of a firm are generally known as the capital budgeting or capital expenditure decisions. There are three aspects involved in investment decisions. These are expansion, acquisition, modernization, and replacement investments lead to exchange of current funds for future benefits. The funds are invested in long-term assets so as to create cash inflows over a long period. The future benefits will occur to the firm over a series of years. Therefore, investment decision is one of the crucial decisions faced by financial managers and also crucial to the success of the business. Company devote time and effort in planning capital budgeting decision because any mistake in capital budgeting process lead to long-term implication for the company itself. Three steps are involved in the evaluation of an investment proposal. These are estimation of cash flows, estimation of the required rate of return, that is the opportunity cost of capital, application of a decision rule for making the choice. Two popularly used discounted cash flow technique are net present value and internal rate of return or IRR. Both the technique discount projects cash flow at appropriate discount rate. Net present value method. Net present value or NPV is defined as the present value of future cash flow discounted at the project cost of capital minus the initial cost outlay for the project. Project with positive NPV should be accepted and project with negative NPV should be rejected. If the two projects are mutually exclusive, the one with higher NPV should be accepted. In mathematical terms, the formula is NPV is equal to minus of I0 plus summation xt divided by 1 plus k raised to power t, where t ranges from 1 to n, where I0 is initial cash investment, xt is net cash flow in period t, k stands for cost of capital, n investment horizon. The most desirable property of NP criteria is that evaluates investment in the same way as the company's shareholders. The NPV method properly focuses on cash rather than on accounting profits and emphasizes the opportunity cost of the money invested. Another desired property of the PV criterion is that it obeys the value additivity principle. That is, the NPV of a set of independent projects is simply the sum of NPV of the individual projects. Incremental cash flows. The most important and difficult part of the investment analysis is to calculate the cash flows associated with the project, the cost funding the project, the cash inflows during the life of the project, and terminal value. Investor interested in what they will get in the future for the investment they are making today. The distinction between total and incremental cash flow is crucial one. Incremental cash flow can differ from total cash flow for a variety of reasons. These are cannibalization, sales creation, opportunity cost, transfer pricing, fees and royalties, accounting for intangible benefits. Cannibalization. When firm's new product take away the sale from existing product, it is known as cannibalization. It occurs when companies set up overseas plant and winds up the substitution foreign production for a parent company exports. To the extent that sales effect estimated must be reduced by the earnings on the lost sales. Sales creation. When investment either created or was expected to create additional sales, For existing products, this is known as sales creation. For example, if company A, which is located in US, significantly expanded its export to Europe after investing in European production facilities, that gave it local position in several product lines. In such case, investment expected to create additional sales. This practice is useful when the main goal is to innovate. In such situation, one has to look to technology for opportunities to disrupt the current playing field. However, for most of the companies, business success is the main goal, and their business success depends on how well they understand and anticipate customers' needs and brings the right product to cater those needs. Therefore, for them, it is crucial that innovation lines up with a critical customer problem that no one has solved. There are many sources of innovation. It can be the result of major system failure by chance and effort by different uncontrollable agents. It can be sourced from external market triggers or from within the company. According to Peter F. Drucker, the general sources of innovations are different changes in market structure, industry structure, local and global demographics in human perception, mood and meaning, in the amount of already available scientific knowledge, etc. The robotics engineer Joseph A. Engelberger said that innovation requires a recognized need, competent people with relevant technology and financial support. For example, the employees of Google work on their own project for 20% of their time, which is known as innovation time off. Atlassian, a software tool company, conducts quarterly shift days in which employees can do anything which is related to the product of the company. Link of innovation with goals and failure of organization. Innovative programs are linked to organizational growth objectives. According to Davila et al., companies cannot grow only through cost reduction and re-engineering. Innovation is very important element in providing aggressive top line growth and for increasing bottom line results. Failures are also possible in innovation programs. Causes of failures can be internal or external to organization. Internal causes are controllable while external causes are uncontrollable. The general causes of the failures are poor definition of goals, poor teams participation, and poor alignment of the actions, poor communication and access to the information and poor monitoring of results. Opportunity cost. If firm A decided to construct new office in Greece on some land it bought 20 years ago, then firm A must include the cost of land in calculating the value of undertaking the project. It should be important to make estimates based on current market value of the land, not the price it paid 20 years ago. Therefore, project cost include the true economic cost of any resources required for the project, regardless of whether firm own the resources or has to go out and acquire the resources. Transfer pricing. If firm sell goods and services to its subsidiary by raising price, this lead to increase in profitability of the firm but at a cost of subsidiary and vice versa. Therefore, the transfer price at which goods and services are traded internally can significantly distort the profitability of a proposed investment. If possible, the price used to evaluate projects, inputs or output should be market price. If no market price exists for the product, then the firm must evaluate the project on the basis of the cost saving. Fees and royalties. Often company will charge projects for many items such as legal counsel, power, lighting, heat, rent, research and development. The charges appear in the form of fees and royalties. They are costs to the project, but they are a benefit from the standpoint of the parent firm. From economic point of view, the project should be charged only for the additional expenditure that are associated to the project, that is, those expenses which is unaffected by the project should not be included in estimation of project cash flow. Accounting for intangible benefits. Intangible benefits in the capital budgeting, such as better quality, faster time to market, quicker and less error prone order processing cost, and higher customer satisfaction, can have a very tangible impact on corporate cash flow, even if they cannot be measured precisely. Similarly, many investments provide intangible benefits in the form valuable learning experiences. It helps companies to get competitive edge. A technique which is used to evaluate foreign projects is to adjust present value approach, that is APV. Adjusted present value technique allow different components of the project cash flow to be discounted separately. This brings flexibility in the process of analyzing foreign project. The APV approach follow different discount rates for different components of the whole cash flow depending upon the degree of certainty ascertained with each cash flow. APV analysis also helps in determining the feasibility of foreign project before accounting for other complexities. If the project is acceptable in this scenario, no further evaluation based on accounting for other cash flow is done. If not, then other evaluation is done taking into account other complexities. APV method is additive approach to capital budgeting. In the APV approach, each cash flow is discounted at a rate of discount consistent with risk inherent in that cash flow, where APV is present value of investment outlay plus present value of operating cash flow plus present value of interest tax shields plus present value of interest subsidies. That is, APV is equal to a negative of I0 plus summation xt divided by 1 plus k raised to power t, where t ranges from 1 to n, plus summation tt divided by 1 plus I raised to power t, and t ranges from 1 to n, plus st divided by 1 plus I raised to power t, and t again ranges from 1 to 10, where tt is equal to tax saving in year t due to specific financing package. St is before tax value of interest of subsidiaries. I before tax cost of debt. Xt the net cash flow in period t. K is the cost of capital. The last two terms are discounted at before tax cost of debt to reflect the certain value of the cash flow due to tax saving and interest saving. The benefit of APV is that it breaks down the value of the project itself, as if it is totally equity financed or totally debt financed. Thus, APV focuses on two main categories of cash flow, which are real cash flow and side effects associated with its financing program. So APV is equal to NPV of the project, assuming it is all equity financing plus NPV of financing side effects. APV breaks the total value into two parts. One part assume no debt is used and then add on the extra value created using debt in the capital structure.
Let us summarize what we have learned from this module. Capital budgeting is the method by which organizations decide how to allocate funds for investment opportunity. Multinational concern assessing foreign investment decision find their analysis problematic by a variety of problems that domestic firm counter occasionally. There are numerous factors which is unique to multinational capital budgeting. Issues in international capital budgeting include transfer pricing, exchange rate risk, political risk, tax factor, and the present versus project approach. Investment decision is one of the crucial decisions faced by financial managers and also crucial to the success of the business. Two popularly used discounted cash flow techniques are net present value and internal rate of return or IRR. Both the technique discount projects cash flow at appropriate discount rate. Net present value or NPV is defined as the present value of future cash flow discounted at the project cost of capital minus initial cash outlay for the project. Net present value is minus of I0 plus summation xt divided by 1 plus k whole raised to power t, where t ranges from 1 to n. The most important and difficult part of an investment analysis is to calculate the cash flows associated with the project. The cost funding the project, the cash inflows during the life of the project, and the terminal value. Incremental cash flow is crucial one and differs from total cash flow for a variety of reasons like cannibalization, sales creations, transfer pricing, opportunity cost, fees and royalties, accounting for intangible assets, etc. A technique which is used to evaluate foreign project is the adjusted present value approach, that is APV. APV is equal to present value of investment outlay plus present value of operating cash flow plus present value of interest tax yields plus present value of interest subsidies. APV is equal to minus of I0 plus summation xt divided by 1 plus k whole raised to power t, where t ranges from 1 to n, plus summation of tt divided by 1 plus I whole raised to power t, again this t ranges from 1 to n, plus summation st divided by 1 plus I whole raised to power t, and t ranges from 1 to n.